NVIDIA swiftly rose to prominence as the industry leader in powering AI, which analysts say is still in its infancy. The next generation of AI is powered by the chipmaker's graphics processing units, GPUs, which supply the computational capacity. Some investors are hesitating due to the stock's explosive recent gain and concerns over sluggish adoption. Unquestionably, artificial intelligence, AI, has changed the technological landscape in recent years. The widespread belief that the low-hanging AI fruit has been picked has been bolstered in recent months by concerns about slowing progress. But the reality is far more complex. One of the best examples is the AI chipmaker NVIDIA. The business is the top provider of the graphics processing units, GPUs, used in data centers, which serve as the basis for AI inference and training. The company's relative growth has slowed, but there is still a strong market for these AI-focused semiconductors. The stock is still very close to reaching a new all-time high, but investors are climbing a wall of anxiety. Let's examine the company's history, the remaining opportunities, and the steps NVIDIA must take to reach a $10 trillion market valuation. NVIDIA has had a 3,480% increase in revenue and a 10,040% increase in net income during the last 10 years. Its stock price has risen 26,000% as a result of this performance and its leading role in the AI revolution. These dazzling outcomes, however, are not a remnant of the dusty past. Much-needed context is provided by the company's recent performance. Although at a slower rate, NVIDIA's profits continued to rise in the second quarter of its fiscal 2026, which ended on July 27th. It brought in a record $46.7 billion, up 17% sequentially and 56% year-over-year. Earnings per share, EPS, increased 61% to $1.08 as a result. With sales rising 73% to $39 billion due to the ongoing demand for AI, the data center segment, which comprises chips used for data centers, cloud computing, and AI, was the market leader. NVIDIA stands to benefit the most from the ongoing adoption of AI since it is the top provider of data center GPUs, holding an estimated 92% of the market, according to IoT Analytics. As of this video, NVIDIA's market capitalization is approximately $4.4 trillion. This indicates that a 126% increase in stock price is required to raise its value to $10 trillion. Wall Street estimates that NVIDIA will make around $206 billion in revenue in fiscal 2026, which would translate into a forward price-to-sales (PS) ratio of 21. To support a $10 trillion market cap, NVIDIA would need to increase its revenue to almost $467 billion a year, assuming its PS stays the same. Over the next 5 years, Wall Street expects NVIDIA's revenue to expand by 26.2% annually. The corporation might reach a $10 trillion market cap as early as 2030 if it can maintain that growth rate. I've stated publicly that NVIDIA will surpass Wall Street's forecasts even earlier because of its propensity to do so. Don't believe anything I say. The IO Fund's CEO and chief tech analyst Beth Kindig has reached the same conclusion. Because of its quick product roadmap, the CUDA, Compute Unified Device Architecture software platform's impenetrable moat, and its status as an AI systems company that offers components far beyond GPUs, such as networking and software platforms, we predict that NVIDIA will reach a $10 trillion market cap by 2030 or earlier. In light of recent developments in AI and its quick development, I believe Kindig is spot on. It's crucial to keep in mind that even if the business is able to reach this significant milestone, there will inevitably be setbacks along the route. The valuation of NVIDIA, which is currently selling for 51 times trailing 12-month revenue, will be cited by bears. In response, I would argue that the price-to-earnings (PE) ratio is not a suitable metric for evaluating high-growth stocks such as NVIDIA. With a price-earnings-to-growth PEG ratio of 0.8, which is more acceptable, any value below 1 is considered to be an undervalued stock. Saudi Arabia is turning its attention to AI-related technology instead of its $500 billion NEOM project, which was launched in 2017 and is a futuristic city. The move signals a move away from large-scale building projects and towards sectors with faster growth and higher rates of return. The new business, Humane, is being supported by the Public Investment Fund, or PIF. It began operations in May 2025 and is currently spearheading Saudi Arabia's AI initiative. In order to invest in companies in the US, Europe, and Asia, Humane intends to establish a $10 billion fund. Additionally, the business has agreements worth $23 billion with significant American tech companies like Qualcomm, Amazon, NVIDIA, and Advanced Micro Devices. By 2034, these agreements will contribute to the construction of new data centers with a capacity of almost 6.6 gigawatts. Oil prices have dropped more than 10% this year, reducing government revenue, which is why this extra spending is being made. Since over half of Saudi Arabia's economy still depends on petroleum, the country's move toward high-tech and artificial intelligence development demonstrates its attempts to get ready for a future with less oil revenue. Neom, the futuristic metropolis that was unveiled in 2017, is waning. After showing up for 3 consecutive years, the project was not mentioned in the 2026 pre-budget report. Work on the line, its centerpiece feature, has decreased and construction has stalled. While some aspects of Neom are still being examined, several contractors and employees have been transferred to other projects. Mohammed Al-Jadaan, the finance minister, has declared that the government will not hesitate to alter or halt a project if it no longer makes sense. This indicates that allocating funds to projects with a quicker payback and a wider global impact is a top goal. The announcement coincides with the arrival of leading international investors in Riyadh for the Future Investment Initiative Conference. Attendees are anticipated to include executives from JP Morgan Chase, Goldman Sachs, and BlackRock as Saudi Arabia announces its next investment phase. The AI drive in Saudi Arabia may provide new markets and supply opportunities for firms such as NVIDIA, AMD, and Amazon. The change represents a larger shift within the Public Investment Fund, which is evaluating major projects and allocating more capital to innovative manufacturing, digital infrastructure, and technology, according to investors. The action shows a change in Saudi Arabia's economic diversification strategy. The kingdom now seems to prioritize high-tech ventures that can bring speedier development and worldwide importance after years of expensive construction spending. Jim Cramer of CNBC stated that the 2 most significant phrases he has heard thus far during earnings season are supply constrained, and he clarified why this dynamic is advantageous for businesses. He claimed that the ability to raise prices when supply is limited is the holy grail of any industry. According to Cramer, one reason for Intel's impressive financial results was that demand outpaced supply. He mentioned that David Zinsner, the company's CFO, stated that the semiconductor manufacturer is facing supply constraints for several products and that industry supply has significantly tightened. Cramer added that in addition to Intel, other tech companies with limited supply that are doing well on the market are Micron, AMD, and NVIDIA. According to Cramer, one of the reasons these businesses don't have enough goods is because artificial intelligence has extraordinarily large storage requirements. Because semiconductor capital equipment businesses didn't produce enough of their own machines because they just didn't expect such a volume of orders, he continued, he believes that demand has outpaced supply. Outside of technology, Cramer stated that he believes supply constraints also affect energy business. GE Vernova and aircraft manufacturer Boeing, with the former likely stating that it is short on the majority of its aircraft when it releases its earnings the following week. He added that GE Vernova's power equipment, such as natural gas-burning turbines, which are the main energy source for the ever-expanding data center industry, is subject to supply constraints. Because they produce expensive goods that other nations can purchase from the United States to help reduce the trade deficit, GE Vernova and Boeing are also expected to benefit, Cramer continued. According to him, the key to strong stock performance is that there is ultimately more demand than supply across a variety of industries. That is not going to change anytime soon, in my opinion. CoreWeave and ARM account for 95% of NVIDIA's $4.3 billion portfolio, a brand that has come to represent artificial intelligence, AI. Because to its strong performance and close partnership with NVIDIA, CoreWeave has been named the finest GPU cloud available. ARM processors are becoming more and more popular in data centers, in part because AI workloads are a good fit for their energy-efficient design. When it comes to artificial intelligence, AI infrastructure, NVIDIA is the industry standard. The chipmaker dominates the market for generative AI networking equipment, in addition to AI accelerators with its graphics processing units, GPUs. According to researchers at Forrester Research, NVIDIA is a global leader in AI infrastructure. Modern artificial intelligence would not be feasible without NVIDIA's GPUs. The chipmaker has decided to support CoreWeave and ARM Holdings because it probably has a clear idea of how the industry will develop. In particular, NVIDIA stated on its most recent Form 13F that it owned $4.3 billion worth of stocks. ARM, a semiconductor business, received 4% of that amount, while CoreWeave, a data center operator, received 91%. NVIDIA's belief is further supported by the fact that it collaborates in some way with both businesses. Investors should be aware of the following information regarding ARM and CoreWeave. CoreWeave offers software services and cloud infrastructure from data centers designed specifically for workloads using artificial intelligence, AI. Its graphics processing unit, GPU cloud platform, is solely based on NVIDIA accelerators. However, both parties gain from the partnership. CoreWeave frequently deploys the newest technologies first and has early access to NVIDIA chips. Furthermore, CoreWeave has made a name for itself as a very skilled data center operator. CoreWeave offers up to 20% greater performance than other clouds, while traditional data centers lose up to 65% of GPU computing capacity due to system inefficiencies. Additionally, the business often presents the best results at the ML perfs, which are objective tests used to evaluate AI systems in both training and inference. CoreWeave was just named the finest AI cloud platform available by SemiAnalysis, a semiconductor-focused research group that gave it a higher rating than Alphabet, Microsoft, and Amazon. CoreWeave's product offerings set a new standard across the GPU cloud industry, stated Dylan Patel, chief analyst. He added that the business was unquestionably at the forefront of GPU cloud dependability. The current price of CoreWeave's stock is 15 times sales, which is a fair price for a business whose revenue is expected to grow by 127% a year until 2026. Patient investors might think about acquiring a tiny stake in this firm because NVIDIA has a strong belief in the data center operator and has promised to buy any unsold compute capacity from CoreWeave through 2032. Central processing units, CPUs, and associated technologies, including as software development tools and compute subsystems, are designed by the semiconductor company ARM. The business, however, licenses its intellectual property to other businesses that wish to create custom CPUs for personal computers, data center servers, and automotive systems instead of selling chips. Because of its power-efficient design, ARM CPUs have long been the industry standard for mobile devices. With regard to smartphone CPUs, the corporation has a 99% market share. But for some of the same reasons, ARM has recently emerged as a significant force in data centers. In other words, gear that uses less power lowers the price of artificial intelligence. But ARM has a compelling business plan as well. ARM allows customers to create unique solutions by licensing designs instead of selling chips. That value proposition has been very appealing to many of the biggest IT companies. ARM architecture has been used by Apple, Amazon, Microsoft, Alphabet, and NVIDIA to construct data center server CPUs. Almost the past 3 years, the company's market share in the data center has increased by almost 10 percentage points. Crucially, since 2021, the number of businesses using ARM architecture to perform AI workloads has increased by 14 times to over 70,000. That trend should be positive to shareholders. The growing need for AI infrastructure is obviously helping ARM, suggesting a long development trajectory. Wall Street predicts that through the fiscal year ending in March 2027, ARM's earnings will grow at a rate of 45% each year. As a result, the current valuation of 110 times earnings appears wealthy without being ridiculously costly. Although it would be wiser to wait for a little better entry point, investors who are at ease with volatility can purchase a small position today. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
I guess that is the question. Just how far can stocks continue to go up? They don't seem to care about anything other than what's right in front of it. Earnings are good. rate cuts are coming and the economy's strong. I don't care about tariff headlines. I don't care about this, and I don't care about that. Is that where we're at?
I think you're right. I mean, it's difficult to make a near-term bear case. I think we came through. There was a test for this market coming through the summer. It's a seasonally weak period of the year, and we had all these systematic buyers that I've spoken about with you on the show, full of stock. We had corporations, which have been a big support to the market, step away during that period of time. And we had excess sentiment. You know, our gauge of sentiment was at 70, which is extreme. Anything over 60 is optimism. That's come back down to 50. So here we are, we're entering into the seasonally strong period of the year. Sentiment has corrected. These systematic buyers have normalized their positions. And corporations are coming back in aggressively at the end of the year. And so we take all that, put it together, and then we say strategists still have their median target below where the S&P is trading out to year end. When you look at all the Q4s where that condition has been at the start of the Q4, we're higher every year except for 2012. And so with an average of about 4%. So you can project that out. And I think that's what we're looking at here. That's the base case. It has to be the base case.
I left something out. I mean, there's a really interesting story that's moved in the last, hour or so. By another news organization where they're quoting Citadel Securities' Scott Rubner. He talks about how powerful retail demand has been, that it continues to act as the price setter of this market. Retail traders responsible for 22% of trading volume in U.S. stocks. Individual investors have been net buyers of U.S. stocks in 23 of the past 27 weeks. What do you make of the power of the retail cohort? Whether we are giving that group enough credit in the role it's playing in this rally?
I think it's changing models in real time of how we look at this market. And I think it explains, I just laid out the case, like many institutional investors were cautious over the summer, given what I just laid out. And retail carried us through. And Scott's work aligns oftentimes with our work. And I know that, so you have that retail bid, and then corporations come back at the level that we expect them to come back at, more than $1 trillion annual run rate that we've seen this year. That's a powerful combination. You know, all these systematic buyers, and you throw retail in the mix. What it means is that we can reset sentiment and reset maybe that 3% correction we got in October was everything we're going to get. And I think that's a little bit surprising and shocking to the institutions. But yes, retail is buying the dip. I think it's part of this debasement trade we've been laying out for a while.